right, welcome everyone. Thanks for tuning in wherever you may be listening from across the Aloha State. Got another episode of the Hawaii Retirement Show here. Today we're going to talk about the 20 common investing mistakes per a document me and Paul came upon from the CFA Institute. CFA is a chartered financial analyst. People with these credentials, they go through really grueling tests. It's really something to be celebrated. Very hard, very difficult. They're kind of experts in all things valuation and ratios when it comes to analyzing finances and stocks in general. But they came up with this list. It's 20. They call it 20 of the most common investing mistakes. And me and Paul thought it was a great list to kind of go through and touch on each one. We'll try to cover mistakes 1 through 10 on this episode, and we'll probably pick up 11 through 20 on the following episode. And I think there's a lot of good info here to go over, a lot of stuff you might know, but always good to touch on these things and remind ourselves of the mistakes that people are making when it comes to investing. Before we jump right in, Paul, anything you want to add to that, and how are you doing today?
Yeah, I'm doing great. When we came across this list, I was excited to just kind of talk through it, give our perspective, right, on some of these thought processes, and ready to jump in.
Cool. Okay, so let's just jump right in here. So on this list, number 1 of the 20 most common investing mistakes is expecting too much. Having reasonable return expectations helps investors keep a long-term view without reacting emotionally. So expecting too much. You want to kick us off there, Paul?
Yeah, absolutely. So when it comes to expecting too much, in this case, they're talking about investment returns, right? And in a lot of cases, even for myself, right, we get into this thought process of this is going to perform really, really well. I'm expecting, double-digit returns. I hear people talk about all these things.
Sure.
We hear those things. The news talks about those things, but really, and we'll talk about this probably concisely throughout this entire 20 mistakes. It's like, if you have the right goals, if you have the right frame of mind, those investment returns, we're looking for long term, right? Typically, right? So for me, I always try to tell clients or help them understand, we aren't expecting these crazy returns. We're expecting reasonable returns, right? And what does reasonable look like? That's different for everybody, but that's typically what I would say. Any extra thoughts for you?
Yeah, I think it's real easy and fun to think best case scenario. Nobody wants to think worst case scenario, and then reality falls somewhere in the middle, right? That's how those things go.
Yeah, and a lot of the time it's kind of in a sense it's anchored by what they hear from other people, right? Right. There's a really well-known financial guru out there that he always projects with, not to tell people that this is what they can get, but 12% is what he always projects with, right? So it's like, well, is that reasonable? I don't know. I mean, is it going to happen every single year? Probably not, right?
Yeah, and I would say too, if you're using these numbers expectations for your retirement planning as part of your budget, leaning a little conservative seems more more realistic than leaning more optimistic, right? For planning purposes.
Absolutely. So I'll just kick off the second one if that's okay.
Yep.
No investment goals. Often investors focus on short-term returns or the latest investment craze instead of their long-term investment goals. Thoughts?
Yeah, and I think it's important to just designate, is this investment for a short term or is it for a long term? What is the return I need? Not that you could guarantee that, but you can invest accordingly as far as the level of risk and volatility in exchange for a higher return. And I think it is good to be clear, like I said, just defining, is this a short-term investment, is a long-term investment? Because you can invest for the short term, and there's nothing wrong with you feel really good about something, you're taking a shot on something. Hey, nothing wrong with that at all. And you think you're going to hit a home run, go for it. But is that a part of your long-term investment strategy, or is this part of your short-term investment strategy? If it's part of your short-term, don't use long-term investment strategy money for your short-term investing. That's what I would say.
Right. And we have, other friends out there in the financial planning world that, every dollar has a job, right?
Right.
And so if we think about that and we kind of position these investments as tools to achieve those goals, right? Whether it's retirement or college or whatever it might be,
Mhm.
first time home, we have to just understand that that goal correlates to some sort of time frame, right? And
Sure.
typically if there's a longer time frame, we can afford more risk. If there's a shorter time frame, by and large, if you're taking significant risk in a short term, then it's really kind of a speculative type of thought process, right? And just understanding that if we have no investment goals, then we're kind of going to go all over the place, and it could get kind of mucky, right? Or it kind of gets all over the place. So I don't know. That's my thoughts on that one.
Yeah, yeah. Peel the onion back. Don't look at everything as one pot. There's short term, long term. There's your money can have different purposes, but it's
Totally.
bucketing those out. Okay, so
Yep.
number three. Let's move on. Not diversifying. Diversifying prevents a single stock from drastically impacting the value of your portfolio. Kick us off there.
Yeah, so we kind of talked a little bit about this in a previous episode, but diversification is it's really important, because whether your employer gives you stock, or whether you particularly like a single stock, right? Maybe it's a really, really big company out there and you really like it. But if you're putting all your eggs in one basket, right? That's pretty much what the opposite of diversification is. It's taking a bet on one company or one thing. And to me, right, in those seasons of one company's doing really, really well, or company's doing really, really poorly, right, the diversification creates that ebb and flow, right? So instead of having these super sharp up and downs, it kind of gradually has those bumps through there. So I don't know, diversification is super important. And I would also say, like, it can also be a sector, right? Sector meaning like a specific area
Sure.
of like someone's like, oh, I'm really hot on technology right now. AI is going to be the next big thing, right?
Right.
Um, so that's pretty much not diversifying, right? You're just going all speculative in that area, which is not a bad thing, right? But it's just, you got to understand that risk. So anyway.
Yeah, we're talking mostly stock market investing, portfolio investing, but I mean this applies to real estate as well.
For
And
sure.
yeah, diversifying a lot of times, it can be things, it could be the thing you least expect is the reason why a company or a stock is hit with turbulent times, right? And it could not be because of the functioning of the business. It could be because the CEO said something on the news that day, and then next thing the stock plummets. So yeah, it's the stuff you don't see coming, right? That'll get you, not the
Right.
stuff you see.
Absolutely. And, not to, point to anything, or, we're not recommending any investments, but, a lot of us heard the news that Hawaiian just got purchased, right? So no one
Right,
expected
right.
that, or at least I
Sure.
didn't know that was going to happen. So, hey, that can change things, right? Positively or negatively.
Right,
Right.
right, right.
Anyway, so I'll kick you number four. Number four is focusing on the short term. It's easy to focus on the short term, but this can make investors second guess their original strategy and make careless decisions.
Sure. So I equate this to the 24-hour news cycle, the modern ADD. It's hard to stick to a plan. Its patience has become a scarce resource. It's easy to just you develop a plan, especially we're coming on the new year here, right? Well, we just passed the new year when this comes out. January 1st, I got my plans, and then everybody knows by the time June comes around, you forget what you even set out to do most times, and things change, right? And it's really hard, but that's why it's great to establish, even for yourself. And Paul, I know we do this with clients, right? An IPS, investment policy statement, or whatever it might be, where it's kind of like your guiding light. Like,
Yeah.
this is what my goals are. This is why I'm invested this way. And, this is what I hope to achieve. And at least that can kind of keep you um, on track and not deviating from, well, I think I should do this now. And I think I should do this. The next thing you know, you changed your kind of investment strategy 3 times within a year. Right. So it's
Yeah.
hard to do, easier said than done, but
Yeah.
yeah, the 24-hour news cycle doesn't help things when you turn on and one person's telling you the sky's falling, the next one's telling you, it's all sunshine and rainbows. So
Absolutely. And, again, not that listening to other people is a bad thing, or even, coworkers or friends, but, a lot of those situations probably don't match up with what you're trying to do. And, it's, you can hear these big numbers, or, and it's like, there's that one common thing, people, it's fear and greed, right? Like the fear of missing out and they want more money, right? So not saying that we shouldn't have a healthy understanding of those emotions and thought processes, but like sometimes, a lot of the times in my thought process, it's probably not going to be within that uh, goal or objective of what the investment should be for you, right? So with
sure.
that in mind.
Yeah, and depending on how you're invested too, the more you change, that you change your mind, it can result in higher transaction fees or trading fees if it's not in your qualified IRA or 401k. So that's
Yep,
something to consider as well.
absolutely.
Okay, moving right along here. Number 5, buying high and selling low. Investor behavior during market swings often hinders overall performance.
Man.
Mm. So falling prey to the market swings.
Yeah, no, this is a big one. I mean, obviously, it's easy to point to certain parts of the market, certain years, right? Like, oh, if you would have done this or that. But, when the stock market goes down and it keeps going down, it's sometimes super scary, to be like, oh no, like I'm losing all of this money. But again, anchoring it back to that goal or the objective or that time frame, right? Like if you got decades left, right? Like the reality is you haven't lost until you sell, right? And if you just are a holder and you're going to hold for years and years and years, there's no risk in it, selling low, right? In that case. And again, we can point to like 2008, right? We all hear those stories, of people that sold out and were
Mm.
scared of it going down, and they never got back in, and they didn't see that, that flow back in and that growth back, right? So, if you have the right goal, you have the right perspective for these investments, you got to take the emotions out of it a lot of times, which is hard. It's super hard. Um, and the value of having an advisor to help you along the way, I think also really helps in this, to kind of say, hey, I think we should just stay the course, right? Yeah.
Yeah, no, I like sometimes the best thing to do is to do nothing, and then I don't have the numbers, readily on hand, but I forget what it is. But any major market downturn, a lot of times the recovery and the upswing happens really quick and fast.
Yeah.
The bounce back, right? And if you're out of the market, you're not going to be in for that quick bounce back. And I think there's a lot of really smart people out there with a really, some really good opinions, but there's just I can't even imagine how many variables go into the stock market and what it does, the economics, the global powers,
Yeah.
the local businesses, the just everything, Congress. I mean, it's just there's so much that goes into it. Anybody trying to predict it, I think it's just too many variables to precisely predict with any you know definitive accuracy. So
Right.
yeah, long-term plans stay the course.
Yeah. And, like you hear this saying, like, it's not about, timing the market. It's about having time in the market.
Sure,
Right.
love that one.
So
Yeah.
it's not about all these triggers. So yeah, I'll jump into number 6, which we talked about a little bit, but trading too much. One study shows that investors with the highest trading activity saw poor performance. Wow.
Hmm. Yeah, and what comes to mind with this one is the recent onset of Robinhood,
Mm,
the app there, and it kind of eliminated any resistance to trading as much as you want on your phone and And it almost creates, I mean, I've seen it with people I know. It almost creates a little bit of a gambling type of environment with the
Yeah.
trading and it's right on your app. So you can see, okay, I made money, I'm gonna lose money, I'm gonna short this, I'm gonna do this. And yeah, you just wonder when the dust settles and the gains are netted against the losses, if a long-term buy and hold strategy would do just as well, right? And yeah, I think trading too much, I think it's fine if again, we talked about it earlier, if that's really what you're into and you like speculating and you like assessing and evaluating companies, I think that's a cool thing. That's a great thing. But just don't use long-term retirement planning money for those purposes, right? Designate the and that's just my opinion. Designate the money that you're going to allocate to this, Robinhood, options trading or whatever it might be.
Right. And, again, I don't have much to add, but, sometimes with different platforms, it just depends, trading has costs, right? So
Mhm.
that fuels the negative, right, as well, where you're paying more just to do all these extra transactions and hoping to make more, right? So again, yeah, totally agree. Trading too much is definitely not something that I would encourage, especially when it comes to that long-term perspective money.
Sure. Okay, so I'll throw you number 7. Paying too much in fees. Fees can meaningfully impact your overall investment performance, especially over the long run. So I before you take it, fees are a necessary evil, and fees serve a good purpose to keep advisors functioning as well as these funds operating. But it is something to keep an eye on. What are your thoughts there?
Yeah, I think it's really important to just understand what the fees are. And if you don't understand and it's kind of tricky or there's a lot of, covering or it's not super transparent, like um it's I think that's really the most important thing. You just have to understand like what's the all-in cost. Is that cost I'm willing to take that cost on because I think the results or the advisor or the program is worth this cost, right?
Right.
Now, I definitely agree, if you're paying too much in fees, it definitely erodes growth, right? So
Right.
um but at the same time, not every investment needs to be that expensive, right? So I think specifically for this question, I'm going to focus just on like mutual funds or ETFs in that respect, right? Where, they have managers. Managers are the ones that are managing these dollars when it comes to picking and, trading and things like that. So if those are really high, you just need to know like, hey, I want to follow this manager or I want to follow this fund. But by and large, if you're in like a like index steady fund, like it should be a low cost because there are really great low cost options out there. So that's how I would look at it.
Sure. And I would just add to that, an advisor in our space that I really respect and like, they always talk about the value that you get, right? What is the value I'm getting for the fees? If you're paying high fees, but you're getting a lot of value in return, I don't see what the problem is there,
Yeah.
right? Now, if
Mm-hmm.
you're paying a high amount in advisory fees or in ETF fees and you're not getting the value, that's where, you might want to reconsider things.
Right.
But always understand, what is the value I'm getting for this fee? It's not just, well, I just got to race to the bottom and pay the
Yeah.
least fees possible, because sometimes those fees provide you with a lot of value in return.
Right. And you might make poor decisions if you had, maybe an advisor or something like that with a little bit more fees, they would have maybe helped you and things like that. So yeah,
Sure.
totally
You never
agree.
know. Right.
Yep. Never know.
Never
Um,
know.
at the end of the day, I think just knowing the fees, knowing the cost is transparency is super important.
Sure.
All right, we'll move on to number 8, just a few more remaining for this one. So focusing too much on taxes. So while tax loss harvesting can boost returns, making a decision solely based on its tax consequences may not always be merited. I really like this one.
Yeah. What is the saying? I hear this all the time and I'm going to butcher it. It's something like, don't let the tax tail wag the dog, or something
Mm,
like that. It's
yeah.
something, I don't know. I like it. But yeah, no, it's just that, like, I think taxes, and we did an episode with Andy Panko recently on taxes and retirement. He made a really good point, is like, you know, you can get 80% of this. I forget what he said. I'm not trying to quote him, but he said something about you can get most of this right. And then the taxes is like the icing on the cake where you're going to optimize and dial things in. Um, but yeah, you don't want to make, I mean, taxes are a huge part of the investment process, the retirement planning process, but you never want to look at anything in a vacuum. If you're
Yeah.
looking at things strictly from a tax perspective, then you might have blinders on to some other things where you're not making the best decision for your goals.
Absolutely. I mean, I think that this is primarily talking about, like, buying at a, selling it at a loss, or, tax, cost, harvesting tax losses and like that, and not necessarily like, to the state you live in and the taxes involved in that. Like, but with what you said, like taxes in a vacuum, right? Like if you're making every decision based off of the tax consequences, then you're really not thinking about like the lifestyle you want to live, where like all those
Right.
different things. Like, hey, maybe like I'm okay with holding on to this position because I really like this, ABC company, or whatever it is, right? Like,
Right.
so again, yes, there are some efficiencies. Yes, there are some reasons to do these things. But again, if making the sole decision based off of taxes is what you're doing, yeah, just caution a little bit there. It's a reason to consider other things.
Sure. Taxes are a necessary evil. You're not gonna get out of paying taxes. It's gonna happen.
Yeah, yeah,
Okay. Two more, and we'll wrap up this episode and pick it up on the next episode. Number 9, not reviewing regularly. Review your portfolio quarterly or annually to make sure you're staying on track, or if your portfolio is in need of rebalancing. There we
yeah.
go.
This is good. Um, so this is like really a direct to consumer type of question. I feel like, not to kind of put it into context, but as an advisor, this is basically what I would say a part of our job is, right? Not the only job, but
Mm,
definitely not the most important job, but it is a part of our job. So
mm,
whether you're doing it, if you're managing your own money, like, yes, absolutely, you should make sure that you are um, quarterly or annually checking to make sure you're on track. Now, the further along, like the further the runway, right? If you have 30 years to go, maybe it's not every single quarter, but have an idea of making sure you're on the right track, that you're taking the right amount of risk in those scenarios. Or if you have an advisor, making sure they're checking up with you at least annually or at least twice a year, right? And maybe the
right.
only conversation is saying, hey, yep, you're on track, you're good to go. Let's focus on other areas. That's definitely okay. But yes, you should regularly review, making sure you're on track. And that might not always just be like investment performance, but like we're taking the right amount of risk. We are,
Mhm.
properly diversified, all these different things. So that's my thoughts.
Yeah, because if you figure out, well, I feel comfortable in my investments at 60/40, stocks to bonds, and you don't check up on it, and we have a good bull market. Next thing you know, you're at 70/30 and the market dips. Well, now instead of 60% of your portfolio being really susceptible to the market dip, it's 70%, and you might have some emotional feelings about that. And that's why it's not as easy as just setting your stock to bond ratio and and staying in those lines, but it can run away, right? It can get lopsided from where you originally started. And I think revisiting just to exactly what it is, rebalance, helps you feel like you're in a good spot for your emotional well-being and investing and your retirement goals.
Yep, absolutely. So last one for this episode, number 10. Here we go. Misunderstanding risk.
Mm.
Too much risk can take you out of your comfort zone, but too little risk may result in lower returns that do not reach your financial goals. Recognize the right balance of your personal situation. Ooh, that was a good one. Kick it off.
Yeah. So much like taxes, if investments were a surefire guaranteed thing, it would not be an investment. You know what I mean? There's going to be some level of risk involved, and we all know there's that correlation between risk in return, right? The reason you get paid a higher return is you're taking on a higher level of risk, and that's okay. And what you can't have is you can't have your cake and eat it too, right? You can't say, well, I don't want any risk. I don't want to see my portfolio, oscillating all over the place on this graph, but I want high returns. Well, that's trying to have your cake and eat it too. You need to accept that risk is part of this thing. And like we talked about through all these other mistakes, that keeping that long-term perspective can help you sleep good at night, I think.
No, absolutely. And if we have, and I know there are people out there that say, don't take an age-based approach or whatever, but I like the component of at least the idea of like, hey, if you're younger, like you might have a conservative like position, like you don't want to take a lot of risk, but because you have so much time, assuming we're talking about retirement, right? You can afford a little bit more risk now because you're not going to want to take a lot of risk when you're, into your 60s or, 70s, right? If we're just looking at purely as an age, right? So just understanding where you're at, age and stage, right? And just knowing that sometimes maybe you are a little bit older and you need to take a little bit more risk because you need a little bit of catch up to do too, right? So there's always different scenarios. And again, it's just helpful to have someone there with you, whether it's an advisor or, that's just talking through these things to help you understand why we would select what we select, or why we think you should do what you need to do. So
Right.
Anyway, that's my last thoughts on number 10.
Yeah, I think that's good. We'll close it out for this episode, and we'll pick back up with 11 through 20 on our CFA's chart here of the 20 most common investing mistakes.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta, Paul McWilliams, and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial or Inspire Advisors. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration. And for Paul McWilliams, investment advisory services are offered through Inspire Advisors LLC, a registered investment advisor with the SEC.